Life insurance is the backbone of America. Something we all hope to obtain, something we can't stop thinking about. And when you finally get this glorious opportunity to sit down with an insurance agent, something you've probably looked forward to your whole life, your entire indexed universal life, you may have been likely faced with two options, term or permanent. So which one makes more sense? That's why we have our specialist, our savior, Jerry Clark here, our insurance wizard. He is going to break down the two different types when you should consider either. This is Your Life Simplified. My name is Michael MacKelvie, brought to you by Mariner Wealth Advisors. Jerry, you seem like a well-protected man. How we doing?
Doing great. How are you doing?
I'm doing good. We're back to talk about more insurance, and we want to know term versus permanent. And in all seriousness, unfortunately, I think insurance is projected much more as a presentation a lot of times than it is a conversation. So, we kind of kid at the beginning, or at least I'm kind of kidding around at the beginning of this episode, but you'll sit through these conversations sometimes and it seems like more of a presentation. We're here to talk strictly a little bit more details about the two different options, not to give any recommendation of any sorts, but let's just start with term insurance or just insurance need in general. How do you even calculate how much insurance need you have in the first place?
Oh, that's a loaded question. I mean, there's one I could do on the back of a napkin. And so basically, me personally, I like to know that I can pay off all my debts and then replace an income. And that's a pretty easy formula, although we can go through all kinds of gyrations of
right,
softwares,
college, whatever it is. Yeah, if you want to add it in. Yeah. Okay, so the napkin option is maybe, hey, how much do you need to replace your income? Hopefully you're getting, if you are sitting down with somebody, a little bit more formal calculation than just that. What's interesting on this too? I don't know if you experienced this. This is just my own personal experience as far as calculating need and having sat down with 100 plus families over the course of my career and doing this. I have two different outcomes. I have an outcome when I would sit down with just the husband where the insurance need was awfully low, if not non-existent, quite often. And an insurance need when we would sit down with both spouses, when the answer would be, well, yeah, we should absolutely get a fair amount of that. This is super important. I don't know if you ever had that experience. Again, it was just, I'm generalizing here, but I noticed that it was always different when you were calculating insurance need when you had both spouses there.
Right.
And a lot of times it's easy to skip over that. Hey, one spouse said they don't really care about it. It's like everybody has different needs, goals, and desires.
Right.
Very critical to go through that conversation with both spouses, right?
That's right.
Now, why might somebody purchase a term policy? Break down what term insurance is, I guess, and then why might they purchase term insurance instead of permanent insurance?
So there's a variety of reasons. I'd mentioned in a previous podcast that I have a 26-year-old daughter and is married, and I have a 3-year-old grandson. And they've got 20 years until my grandson is 23, and they probably gonna have more kids. So they're going to look at a 20-year term to take care of the vast majority of, if one of them was to die prematurely. That's the most common use of term insurance. Take me now, for example. I'm pushing four decades in the business. Okay, and I'm just honest confession's good for the soul.
Yeah,
I'm 59. I have a pension plan, the old pension plans. I have a pension plan that's going to kick in at age 65. Mm-hmm. And I have about a 6-year window here that I'm going to work and then I'm going to retire. There is a shortfall right now, even though I'm an empty nester and I'm a granddad, there is a shortfall in my calculation. So I picked up a 10-year term contract at the start of COVID, just because I wanted to make sure my wife was taken care of if, I don't make it to age 65.
Right.
But come age 65, I'll drop the term insurance and we'll live on the pension plan. So there's all different types of temporary needs that are out there, and they cross over all ages.
Yes.
And then
that's a critical point. Critical point there. There's different temporary needs. And, I think with term insurance, we want to be sure to distinguish, individual term policy versus like a group term policy that you might get through work. I see this sometimes, the words are misunderstood or misrepresented. So individual term policy, you're going to some insurance company, likely having some underwriting process. You're getting maybe a period or a term of insurance that would then be guaranteed to you. So a 10 or a 20 or even a 30-year policy that you might get. That's important to highlight, because if you go to your company and you say, because I'm just speaking from like these different examples, these different experiences I've had, you sit down with someone, they say, well, I haven't, term insurance through my work. Well, what happens if you leave that company? What happens if you pass away? Is that enough money? Are they offering you enough insurance? Which is more cost effective in the long run? People don't realize that. It's more cost effective quite often, as long as you're like in decent health, right? To have an individual term policy. I mean, I would run this out for people when I was placing, individual term policies, especially before COVID, but also still today. And a lot of times it's less expensive. Plus, again, if you leave the company, you're guaranteed that coverage, which most people are leaving their employers every few years now. Additionally, the conversion options cannot be you can't underestimate the power of that. If something happens to you to where you become uninsurable, let's say, and I had this happen actually just a couple of years ago. I had a friend of mine, a neighborhood friend of mine, who was diagnosed with terminal brain cancer. He has a term policy in place. And fortunately, we have this term policy that has conversion options, right? You don't know when those things can happen. I'm not sitting here to be like fearful. It's like, no, like that's not only more cost effective a lot of times to have an individual term policy, but you also get these conversion options that you won't get through your work. Right. So it's important to highlight, right?
Yeah. Well, and the reason term insurance through the group is more expensive is typically it's guaranteed issue. So there's a lot of excess risk that the insurance company is picking up because of, they're taking on a fair amount of uninsurables in the group. Whereas you go out and buy insurance on your own, you're subjecting yourself to underwriting. So if you're not insurable, you're not going to get a contract.
Right.
And so the price point is going to be a lot more competitive on an individual basis.
Yeah. And typically, whatever number you have in mind, give it a little bit more thought as far as what your insurance need is, because we tend to drastically underestimate what that need is. It's like, well, I make a couple $100,000. Yeah, I have a $500,000 policy. That'll last you a couple years. Probably not enough, right? Depending on where you're at in life. So again, make sure to calculate that need. Now, permanent insurance, help us understand what permanent insurance is. Obviously, there's different types, but help us understand what permanent insurance is and when you might consider a combination of term and permanent, or consider permanent at all.
Well, so, if you have a permanent need, you need permanent solutions. And so that's the reason you get permanent insurance. I do have a beef with the terminology permanent insurance, because there's a lot of people that go out there and they buy permanent life insurance and they think that there's no way it ever lapses. Okay. And so they haven't investigated all the risk associated with running out of cash value because of performance or lack thereof, and what they thought was in place. Yeah. We saw, for example, in our last podcast, we were kind of talking a little bit about the Wizard of Oz, the man behind the curtain, and whole life. And that one thing we didn't talk about in that podcast was the invention of true universal life that came about in like 1979.
The 70s.
Yeah, so it was invented to take advantage of high interest rates. And so there was a lot of people out there selling in the 70s and 80s when I got my start in the business. They were out there selling universal life as if it was some wonderful cure to cancer, almost like,
Yeah.
if you bought this was the best thing since
Right.
sliced bread. And they
Yeah.
really downplayed the risk. Okay. And when
Right.
I got into the business right out of college, say 1986, I analyzed the interest rate environment and I was like, interest rates are going to come down. They're going to go to historical norms. We're in an anomaly here. And when this does, it's going to crater these universal life contracts.
Right.
People are going to think, oh, I'm paying X and that's good forever. And what they
Yes.
found out is they ran out of money and X went to XX, XXX, and then it lapsed.
Right.
And so, yeah, it's a permanent insurance product.
Right. Right.
So
Very
I like
important.
distributing to a fiduciary standard because you guys hold me to task on that. It's
Yeah.
like, okay, I want to make sure that this is in force when the day comes.
Right. When the day comes. Yeah. That's why it's so critical to understand the confines of the contract, the guarantees that are maybe associated with that, because permanent policies might not be as permanent as you might think. Now, with that being said, I always make sure to, underline this and really emphasize this. Just because it's insurance doesn't mean that you should write it off as a valuable potential asset in your overall portfolio, in your overall net worth, right? Not just from a protection standpoint, but you mentioned a permanent need in estate planning standpoint. Um, Permanent insurance can absolutely play a role in its tax efficiencies. The tax-free benefit that you would get from it is attractive, especially for a state that's maybe estate taxable. So there's some different things that you can do there. We won't delve too much into it. My point there is you shouldn't just write this off because it has insurance. I know that most people don't like insurance until they need it, right?
Right.
So again, be willing to be open to it. I did have a question though. You mentioned interest rates. How does that affect a rising interest rate environment? How does that affect permanent policies, not only ones that are in place, but the ones that are maybe now just getting issued? We see companies changing maybe their dividend rates. We see companies changing maybe some different parts of their general account. I mean, how does it change the permanent insurance outlook as interest rates rise?
Well, so typically when rates go up, this is me wading into your territory, but when rates go up, stocks tend to take a hit. Is that fair to say?
I mean, historical evidence, but again, historical returns are
Yep.
not indicative of future. But
Right.
yes.
Okay, so if you're in the variable environment, you're fully invested in growth accounts, and interest rates come up, then boom, you may take a hit there. And then bond accounts, for example, if you're in a bond account in a variable life, it's going to take a hit as well.
Mhm.
The whole life environment is kind of a lagging. I think it kind of lags. This is
Very
personal
true.
opinion. I think it lags behind these rate increases.
I don't think that's a personal opinion. I think that's much more close to reality. I don't have like an entire study in front of me to say exactly, but yes, I am with you there. I think it
Yeah.
can lag. I think it's more as you mentioned general account. I want to make sure to define that because the audience might be like, what is that? General account being the account the insurance company is managing, right, in order to make these claims, in order to pay out
Right.
benefits, right? And so they have, because they're insurance companies, they have confines that they have to operate within as far as how they can invest the money. They can't take all the money and just go throw it into the S&P 500, right? So they have bonds. A large part of their general account is invested in bonds.
Right.
Well, these 30-year treasuries have been fallen off from the
Right.
80s, from the 90s, when interest rates were higher and we had very low interest rate environment the last couple of years. So they're replacing them with lower rates, which is why you've seen dividends across the board go like this
Right.
as time has gone on, i.e. performance of the permanent life insurance policy. Now, as interest rates go up, it's lagging, so it'll hurt maybe for the first few years, but theoretically, over time, as interest rates come back up, that would strengthen the general account in the long run, all things else equal. It's just that there will be that leg of performance maybe for a few years
Right.
that you'll see, because again, everything in the general account is getting hurt. The bonds are getting hurt because the price
Right.
is down. The stocks are getting hurt because, well, again, as we just touched on, inflation
Right.
going up can hurt equity prices, can force them to go down. But in the long run, theoretically, higher interest rates from what we were at is a better thing for the general account. It's just going to take some time
Right.
for that to play out. So lagging, I think, is a proper way to mention that. What else should we know about permanent insurance?
Well, so everybody has their own personal opinions. And as I mentioned, I like distributing to a fiduciary standard. So the hardest person for me to get anything passed, if you will, not that we're trying to get anything past anything, is the advisor, because you're out on the front line looking out for what is absolutely in the best interest of your client. And
Mhm.
so I'm kind of like you in that, you know, I don't believe that buying permanent insurance solves every problem in the world. And certainly I've had experience in my near 4 decades now of salespeople that you you would think that if you just buy
That is
this,
the case.
yeah, exactly. So
Yeah.
um, I I look at funding your 401k, get your deductions, okay, get your tax deferred growth, build a portfolio of long term capital gain product assets so that you could leverage those later and buy businesses and things like that. Life insurance, cash value life insurance, or permanent life insurance is kind of like the third leg of the stool.
Mhm.
I don't throw it down right out of the gate. Whereas if
Right
you
out of the
spend a
gate.
whole, yeah, like if you spend a whole lot of time with a person that has a vested interest in selling you
Right.
life insurance,
Some
guess what?
captive company.
You're
You're
going to get life insurance.
you're gonna get that conversation. You know what's funny about that? What's fascinating? You either have advisors or financial representatives that can't stop talking about it, or advisors that don't talk about it enough. Like there's not a lot of times there's not that middle ground, right? So like I've noticed that for a lot of just, fiduciary advisors, wealth planning advisors that maybe didn't come from like the insurance side of things, they maybe are more likely to not have that risk management conversation to the length that they should.
Right.
I'm not saying that's all of them, but again, like, just speaking candidly here from my experience, you will have advisors that, because it's an uncomfortable conversation, maybe don't take it to where it needs to go. And I think that is something that's worth highlighting is you got to have this conversation as a client, as an advisor with somebody, because things happen. You can't shy away from it. But at the same time, it's not the only solution on the permanent
Right.
side, as it often is portrayed and illustrated, right?
And it's a team sport. So if you've been around me for any length of time, I always talk about the Socratic method. Question, answer, truth becomes known. And
Yeah.
so at the end of the day, if you feel like you're meeting with somebody across the kitchen table and you're not, you don't feel like you can ask questions, or you're not smart enough to ask questions, you need other representatives at that kitchen
Right.
table, people
Yeah.
that will ask those hard questions and get those.
Otherwise, what's the point of the advisor? They're not there just to be your friend.
Right.
As bluntly as I could put that. And I will tell you, that's always been a conversation. It's just not the easiest one to sit down and be like, hey, you know, obviously things can happen. We need to make sure that we create plans for when these things happen, right? Now, again, I'm not here to be parental with other advisors and tell them how to do things.
Right.
I've just kind of picked up on that, and I think it's worth noting. So, anything else in the permanent or term insurance category you think is worth touching on?
Well, I do have a bias on variable life. So back in the 80s when I got started, I was being mentored into being a whole life salesman, which is what everybody did back then. And I kind of ask a lot of those Socratic method, question, answer, truth becomes known. And I started looking at, investment grade life insurance, cash value. And back then we didn't have secondary death benefit guarantees. It's a conversation for another day.
Yeah.
But basically, the variable life that was originally invented was kind of a market-based product. And if the market took your cash value away from you, you ran out of coverage or you paid a lot more in premium. The products today, they've built some nice wrappers around the separate accounts. So premium guarantees, for example, death benefit guarantees, plus the market return. And so I've become a big believer in variable life, just because so many people I meet with, they're just not getting rates of return with fixed investing. And so
yeah, it's been a change in times, and that's where like that generalized knowledge that you maybe hear passed down generation to generation can quickly change and might not be the most sound advice. Same thing with like home loans. We saw a period of time there where it was like you're getting 2% home loan rates. So yeah, a 30-year mortgage is a lot more attractive than when it was 15%, right? And you can maybe do the 15-year loan instead of the 30-year, right? So yeah, it's very much a question of what's the current outlook, what are the times that you're in, and what is your current situation and goals, right? So I think the last thing I'll just add on that makes permanent insurance, I believe, something worth considering more is the ability to add a long-term care rider. So in my state, Washington, they recently required everybody to get either a long-term care policy or pay a payroll tax. First state to do it. I would not be surprised if more states don't do this, because Medicaid is just draining states right now, draining them. So the way that you got out of the state tax and the state plan is if you had your own private personal plan. For the majority of the people that I sat down with, a life insurance policy with a long-term care rider, it had to be a qualifying rider, was the most attractive option for them. So the ability to pool those two needs together, potentially, you might not solve both of them perfectly, but the ability to pool those needs together, because the big qualm with LTC is, well, what if I don't use it? Well, life insurance, 2 out of 2 people die. You're going to use it, right? So you're guaranteed to get some benefit out of this. That was enough assurity to where they said, yeah, I think I'll opt to choose that option over just straight line LTC insurance. And then that got them out of the tax. So that would be the last thing that I would add on there. But thank you for today. This has been helpful. Again, a question that comes up a lot of the times: should I do term insurance, permanent insurance, a combination of the both? My name is Michael MacKelvie. I was joined by Jerry Clark, our insurance specialist here at Mariner Wealth Advisors. This is Your Life Simplified. You guys take care.
Mariner Wealth Advisors, or MWA, is an SEC-registered investment advisor with its principal place of business in the state of Kansas. Registration of an investment advisor does not imply a certain level of skill or training. MWA is in compliance with the current notice filing requirements imposed upon registered investment advisors by those states in which MWA maintains clients. MWA may only transact business in those states in which it is notice filed or qualifies for an exemption or exclusion from notice filing requirements. Any subsequent direct communication by MWA with a prospective client shall be conducted by a representative that is either registered or qualifies for an exemption or exclusion from registration in the state where the prospective client resides. For additional information about MWA, including fees and services, please contact MWA or refer to the Investment Advisor Public Disclosure website at www.advisorinfo.sec.gov. Please read the disclosure statement carefully before you invest or send money. The views expressed in this podcast is for educational purposes only and do not take into account any individual personal, financial, legal, or tax considerations. As such, the information contained herein is not intended to be personal, legal, investment, or tax advice. Nothing herein should be relied upon as such, and there is no guarantee that any claims made will come to pass. The opinions are based on information and sources of information deemed to be reliable, but Mariner Wealth Advisors does not warrant the accuracy of the information. Asset allocation diversification is a strategy designed to manage risk, but it cannot ensure a profit or protect against a loss in a declining market. Certified Financial Planner, trademark, CFP, registered trademark, and federally registered CFP with flame design marks, collectively the CFP registered marks, are professional certification marks granted in the United States by Certified Financial Planner Board of Standards, Inc., also CFP Board. The CFP registered trademark certification is a voluntary certification. No federal or state law or regulation requires financial planners to hold the CFP certification.